Something important is unfolding around XRP right now, and surprisingly, very few people seem to be paying attention. For years, the common perception surrounding XRP was simple. Most people heard the name and immediately associated it with one specific use case: fast cross-border payments. That reputation came from the early vision promoted by Ripple, where the asset was designed to act as a bridge currency, helping banks move money across borders more efficiently. But the ecosystem developing around XRP today is becoming far more complex than that original narrative. Quietly, developers, financial engineers, and institutional players are working on infrastructure that could transform the XRP ledger into something much larger than a payment rail. The focus now is shifting toward credit systems, liquidity networks, and financial services that could eventually create yield opportunities for XRP holders while connecting the network directly to institutional capital markets. At the center of this discussion is the idea of bringing a digital version of prime brokerage onto the blockchain. For anyone unfamiliar with that term, prime brokerage is essentially the invisible framework that powers large portions of the global financial industry. Hedge funds and major trading firms rely on prime brokers to borrow capital, access liquidity, manage collateral, and execute complex financial transactions across multiple markets. Behind the scenes, billions of dollars move through these systems every day as institutions manage leverage, settle trades, and coordinate with multiple counterparties. Traditionally, this entire structure runs through legacy banking infrastructure that can be slow, expensive, and heavily dependent on intermediaries. What Ripple and developers within the XRP ecosystem appear to be exploring is a version of that same machinery rebuilt on blockchain rails. In a blockchain-based prime brokerage environment, credit lines could exist directly on-chain, collateral could move instantly between institutions, and trades could settle far faster than the traditional settlement cycles used in legacy finance. That would allow institutions to use their capital more efficiently while reducing counterparty risk and operational friction. Importantly, this concept is very different from the speculative decentralized finance platforms that became popular in earlier crypto cycles. Instead, the goal resembles something much closer to traditional Wall Street infrastructure, but redesigned using blockchain technology as the underlying settlement layer. If the XRP ledger eventually evolves into a network capable of supporting these prime brokerage-style services, the implications could be significant because it would connect the XRP ecosystem directly to the same financial pipelines used by hedge funds and large institutional investors. However, none of this potential matters if financial institutions cannot move assets smoothly between different networks and platforms. Interoperability is the missing piece that determines whether blockchain systems operate as isolated islands or as part of a larger global financial network. This is where infrastructure projects connected to the XRP ecosystem begin to play an important role. According to insights shared by blockchain engineer Hugo Fillion, the real power of networks like the XRP ledger and the Flare network comes from their ability to remove friction between participants in financial systems. In traditional banking, moving money often requires navigating layers of bureaucracy, identity checks, settlement delays, and institutional silos. Blockchain rails, by contrast, allow assets and information to travel across protocols and institutions with far fewer barriers. When friction disappears from financial systems, efficiency increases dramatically. Transactions settle faster, capital moves more freely, and institutions gain the flexibility to interact with liquidity pools and financial protocols almost instantly instead of waiting for outdated settlement windows to close. Right now, something unusual is happening around XRP, and most people scrolling through charts or arguing about short-term price moves are completely missing it. For years, the conversation around XRP has been simple. It's the fast one, the token built to move money across borders quickly. That narrative has been repeated so often that it became the default description in people's minds. But quietly, behind the scenes, the story has started to evolve into something much larger. What's forming isn't just a faster payment rail. It's the early outline of a financial system where liquidity, credit, and institutional capital interact directly on blockchain infrastructure. Imagine the machinery that keeps Wall Street functioning every day: prime brokerage services, lending desks, collateral management, settlement systems. Except instead of being buried inside legacy banking networks, those functions begin operating on open blockchain rails. That's the direction the XRP ledger appears to be moving toward. Ripple's strategy is increasingly focused on building the kind of financial plumbing institutions actually rely on. Prime brokerage is a good example. In traditional finance, prime brokers sit at the center of massive capital flows. Hedge funds use them to borrow funds, access leverage, and manage risk across countless counterparties. It's the backbone that allows large financial players to move billions efficiently while keeping everything balanced and accounted for. Now imagine those same capabilities being rebuilt on blockchain networks. Instead of settlements that take days, trades finalize in seconds. Instead of multiple intermediaries adding friction and cost, transactions move across a streamlined digital infrastructure. Instead of fragmented pools of liquidity, capital can flow between networks and institutions almost instantly. This is where things start getting interesting for XRP itself. If the XRP ledger becomes one of the Rails institutions used to handle these functions, then the token isn't just a digital asset sitting in a wallet waiting for speculation to push its price higher. It becomes part of the infrastructure enabling financial activity. And infrastructure assets behave very differently from speculative tokens. When something becomes embedded in the operational layer of finance, it gains relevance that goes far beyond market cycles. But none of that works if financial networks remain isolated from each other. One of the biggest inefficiencies in traditional finance is fragmentation. Every bank, payment processor, and market operates inside its own silo, and moving capital between them introduces delays, compliance hurdles, and operational costs. Blockchain rails like the XRP ledger aim to remove that friction by allowing assets and liquidity to travel between systems with minimal resistance. When friction disappears, efficiency increases dramatically. Transactions settle faster, capital gets utilized more effectively, and institutions can interact with multiple financial platforms without constantly rebuilding infrastructure. That concept, reducing friction, is one of the core reasons blockchain technology gained attention in the first place. If networks like XRPL and others successfully provide seamless interaction between institutions, then the value of those rails grows significantly. Suddenly, the conversation around XRP shifts from speed alone to something much more foundational, the movement of liquidity itself. And when liquidity begins flowing freely across networks and protocols, entirely new financial opportunities start to appear. Once liquidity can move freely across networks, another concept enters the picture that tends to make people sit up and pay attention: yield. The moment that word enters the conversation, the entire dynamic changes. Yield means capital isn't just moving, it's working. And the idea that XRP could participate in yield-generating financial activity has started appearing more frequently in discussions among platforms and infrastructure providers. This isn't about minting more tokens or distributing rewards in the same way proof-of-stake networks operate. Instead, the concept revolves around real financial activity built on top of the XRP ledger itself. When lending markets, liquidity pools, and collateralized borrowing systems exist within a network, assets sitting idle can begin generating returns. It's the same principle used in traditional finance through money market funds or repo markets. Idle capital becomes productive capital. Platforms have already started exploring how this model might look. Imagine depositing digital assets as collateral while continuing to hold them, allowing access to credit lines without selling your position. That concept already exists in various financial environments, but bringing it onto the XRP ledger would allow those mechanics to function directly on blockchain infrastructure. A holder could theoretically deposit assets like XRP or stablecoins, access liquidity through loans, and repay those loans over time without ever liquidating the underlying holdings. The asset remains in place while financial activity takes place around it. The key element that makes this possible is lending and borrowing functionality embedded directly into the ledger. That's where a proposal known as XLS66 comes into play. The amendment outlines how lending markets could operate natively on the XRP ledger, allowing users to deposit digital assets into vault-style accounts that support collateralized borrowing. Instead of relying on external applications or bridges, the functionality would exist directly within the network itself. If approved, participants could deposit assets, borrow against them, provide liquidity to lending pools, and potentially earn returns from the activity flowing through those markets. But proposals like this don't activate overnight. The XRP ledger requires validator consensus before major changes take effect. Validators must approve an amendment with an 80% threshold, and that approval must remain above the threshold for a continuous 2-week period before activation occurs. As of now, support remains far below that requirement, so nothing about this system is operational yet. Still, the presence of the proposal itself reveals something important. It shows where the ecosystem intends to move. The goal isn't just payments anymore. The destination appears to be a broader financial environment where lending, liquidity, and institutional capital all operate on the same infrastructure layer. Even before the voting threshold is reached, the proposal functions as a signal. It demonstrates that developers and ecosystem participants are actively designing the components required for a fully functioning financial ecosystem built around the XRP ledger. When you step back and look at the bigger picture, the direction becomes clearer. Ripple's leadership has repeatedly hinted that their long-term vision goes far beyond individual payment transactions. They're looking at the massive flows of capital that move through global financial systems every day. One example that caught a lot of attention came during a major industry appearance where Ripple's leadership discussed the potential scale of treasury flows interacting with blockchain infrastructure. The number mentioned was staggering, up to $14 trillion in treasury-related financial activity that could eventually intersect with systems built around Ripple's technology stack. To understand why that figure matters, you have to consider how large the treasury market actually is. Government bonds and treasury instruments represent some of the deepest and most liquid markets in the world. Banks, corporations, and investment funds constantly move capital through those markets as part of daily financial operations. If even a fraction of that activity begins interacting with blockchain-based settlement systems, the infrastructure supporting those transactions becomes incredibly important. Ripple's strategy seems to revolve around positioning itself directly in the middle of those flows. Acquisitions and partnerships provide clues about how they're approaching the problem. For example, the acquisition of companies involved in treasury management and prime brokerage services places Ripple in contact with thousands of corporate clients already managing enormous financial flows. Those businesses process trillions of dollars in payments every year using traditional banking infrastructure. None of that activity currently relies on blockchain or digital assets. But once a company is integrated into Ripple's ecosystem, the opportunity exists to gradually introduce blockchain-based tools that improve efficiency. That might start with stablecoin settlements, cross-border payments, or liquidity optimization strategies. Over time, as companies become comfortable with the technology, additional services can be layered in. The strategy doesn't involve forcing clients to abandon their existing systems overnight. Instead, it introduces new tools that offer measurable advantages. If a corporation realizes it can hold treasury balances in digital stablecoins and earn better returns, or settle international payments faster and cheaper using blockchain rails, adoption becomes a practical decision rather than a speculative gamble. This gradual integration approach aligns with how large institutions typically adopt new technology. They move carefully, test systems in controlled environments, and expand usage once reliability and regulatory clarity improve. Ripple's leadership often describes XRP as the North Star, guiding the company's long-term strategy. That means many of the seemingly unrelated moves Ripple makes eventually connect back to the XRP ecosystem in some way. Sometimes the connection is obvious, like cross-border settlement using XRP as a bridge asset. Other times the connection may involve several steps before it becomes visible. But the underlying goal remains consistent: expand the financial infrastructure surrounding XRP until it becomes an integral component of how capital moves through the global financial system. What makes this transformation interesting is how dramatically it shifts the conversation around XRP itself. For years, discussions focused almost entirely on price speculation. Investors debated market cycles, short-term trading opportunities, and predictions about how high the token might climb during the next bull run. Those conversations still exist, but they miss the deeper narrative forming beneath the surface. If the XRP ledger evolves into infrastructure supporting lending markets, institutional liquidity flows, and tokenized financial assets, the token's role becomes much more structural. Infrastructure assets don't behave like speculative tokens, they derive value from usage. Every time capital moves through a system, interacts with liquidity pools, or settles transactions, the infrastructure enabling those operations becomes more relevant. Ripple's broader ecosystem already includes several components designed to support that infrastructure. Payment rails allow institutions to move funds across borders quickly. Stablecoin infrastructure introduces digital dollars that can settle instantly on blockchain networks. Custody solutions provide secure storage for digital assets used by large organizations. When these elements work together, they create a full financial stack capable of supporting enterprise-level operations. Ripple recently outlined a detailed blueprint describing how these components connect. The system includes on-ramps for converting fiat currency into stablecoins, off-ramps for converting back to traditional banking networks, digital wallets for storing assets, payment orchestration layers coordinating transactions, custody infrastructure safeguarding funds, and blockchain settlement layers processing transactions in real time. This entire architecture is designed to function as a complete financial ecosystem rather than a single standalone product. The emergence of tokenized real-world assets further expands the possibilities. Exchanges and financial platforms have begun issuing tokenized representations of assets such as private credit, bonds, and equities on blockchain networks. When these assets exist digitally, they can settle instantly and interact with decentralized financial systems in ways traditional assets cannot. Projects already underway demonstrate how large institutions might use the XRP ledger to tokenize regulated assets, increasing liquidity and accessibility while maintaining compliance. As more assets become tokenized, liquidity within the network grows. Greater liquidity attracts more participants, which in turn increases network usage. This cycle gradually transforms the blockchain from a niche technology into a core component of financial infrastructure. That transformation doesn't necessarily happen overnight, but once momentum builds, it tends to accelerate quickly. Market conditions today reflect a transition period where infrastructure development continues while speculative activity temporarily cools down. Trading volumes fluctuate, leverage decreases, and open interest occasionally drops as traders wait for clearer market direction. These quieter phases can feel uneventful on the surface, but they often occur while deeper structural changes take place behind the scenes. When leverage exits the market and speculative positions unwind, price movements sometimes become less dramatic in the short term, yet those periods frequently precede major directional shifts once new catalysts appear. At the same time, developments across the broader digital asset ecosystem continue to reshape the environment in which XRP operates. Tokenized equity markets are gaining attention from major exchanges exploring ways to connect regulated securities with blockchain infrastructure. Partnerships between traditional financial institutions and crypto platforms aim to create frameworks where tokenized stocks and assets can move between regulated environments and global on-chain markets. These initiatives involve cooperation with regulators, issuers, and financial infrastructure providers to ensure compliance while enabling new forms of asset mobility. Regulatory clarity remains one of the most critical factors influencing institutional adoption. Banks and large financial firms typically require clear legal frameworks before investing billions into new technologies. Once those frameworks emerge, however, adoption can accelerate rapidly. Policymakers and regulators have increasingly acknowledged the importance of providing guidance around digital assets, stablecoins, and blockchain infrastructure. Industry leaders frequently participate in discussions shaping those rules. When companies like Ripple engage directly with policymakers to help design regulatory frameworks, it indicates that blockchain technology is moving from experimentation toward integration with traditional financial systems. Institutions recognize that digital infrastructure will eventually replace many analog processes still used in banking today. Building that infrastructure requires significant investment and cooperation between technology providers, regulators, and financial institutions. For banks, Regulatory certainty often determines whether large-scale projects move forward. Without clear guidelines, legal departments hesitate to approve major technological transitions. But once clarity arrives, banks may begin investing heavily in the infrastructure required to remain competitive. The digital transformation of finance is not purely theoretical anymore. Stablecoins already process enormous transaction volumes, and blockchain networks continue expanding capabilities that rival traditional financial systems in speed and efficiency. As these technologies mature, the distinction between traditional finance and decentralized finance may gradually blur, creating a hybrid system combining elements of both worlds. Looking back through Ripple's history reveals that many of the developments unfolding today were part of a long-term plan articulated years earlier. Early presentations from company leadership emphasized a singular mission: transforming the way value moves across the world. The comparison often used was simple but powerful. Money should move the way information moves across the internet, instantly and without unnecessary friction. Achieving that vision required building partnerships with banks, payment providers, and financial institutions capable of integrating blockchain technology into existing financial networks. At first, the focus remained on cross-border remittances because that market alone represents trillions of dollars in annual transactions. The strategy involved solving one major problem first before expanding into adjacent financial services. Over time, however, Ripple's ecosystem began branching into additional areas, including trade finance, tokenization, custody services, and digital asset infrastructure for institutions. The company effectively moved from being a payments provider to becoming a broader financial technology platform built around blockchain rails. This expansion mirrors how major technology companies often evolve. They start by solving one critical problem exceptionally well, then leverage that success to expand into related industries. Ripple's approach reflects a similar progression. Cross-border payments served as the entry point, but the infrastructure built to support those payments eventually enables other financial services. Now the question becomes what Ripple might be developing today that won't fully emerge for several years. Technology companies frequently operate several steps ahead of public awareness. By the time the broader market recognizes a trend, the foundational work may already be complete. Ripple's investments and partnerships hint at future areas of growth, including automated financial systems driven by artificial intelligence and machine-to-machine transactions executing across blockchain networks. Over the coming decades, billions of automated financial interactions could occur without human intervention. AI systems might manage liquidity, rebalance portfolios, or settle payments in real time across global networks. Blockchain infrastructure provides the transparency and programmability required for those automated processes to operate securely. Ripple's collaborations with major financial institutions and payment networks suggest that the company intends to play a role in that future ecosystem. Whether through stablecoins, digital asset settlement layers, or liquidity networks spanning multiple jurisdictions, the goal appears consistent: position XRP-related infrastructure at the center of how value moves in the digital economy. If that vision materializes, the discussion surrounding XRP will look very different from today's debates about price charts and market cycles. Instead of being viewed primarily as a tradable token, it may be recognized as a component of financial infrastructure supporting global liquidity flows. And once infrastructure becomes embedded within the financial system, it rarely disappears. It becomes the foundation upon which the next generation of financial innovation is built.